On January 30th, 2026, the global silver market experienced one of the most shocking and violent price collapses in modern financial history. On Friday morning at 9:30 a.m., silver suddenly dropped 30%. Hello friends, if you are new to the channel, subscribe to the channel. After weeks of an extraordinary rally that had driven prices to record peaks above $120 per ounce, traders, investors, and even casual observers were stunned as the price of silver plunged by more than 30% within a single trading session, wiping out weeks, in some cases months, of gains that had seemed unstoppable just days earlier. What began the day as a feverish, bullish atmosphere transformed into a cascade of fear, forced selling, and systemic unwinding that rippled through commodities markets around the world. In the weeks leading up to January 30th, silver had been on an astonishing run. Bullish sentiment had been fueled by a combination of safe haven buying amid geopolitical uncertainties, speculative interest in precious metals, and a perception that central banks were poised to keep monetary policy extremely accommodative. Industrial demand, particularly from sectors like green energy and electronics, was strong. Technical indicators showed silver in overbought territory, with momentum pushing prices higher and higher, supported in large part by leveraged positions in futures and exchange-traded instruments. Many market participants were betting that silver would continue to rise, and as prices climbed, more and more capital flowed into the market, convinced that the rally had only just begun. Then, on the morning of January 30th, the narrative changed. News broke that U.S. President Donald Trump had nominated Kevin Warsh as the next chair of the U.S. Federal Reserve, a development that blindsided markets. Warsh, a former Fed governor with a reputation for prioritizing price stability and a strong dollar, was perceived as more hawkish than many investors had anticipated. The announcement triggered an immediate repricing of global monetary expectations. Traders began to anticipate that interest rates would stay higher for longer, or that rate cuts previously priced into markets might be scaled back or delayed. As a result, the US dollar strengthened sharply and Treasury yields climbed. A stronger dollar and rising yields are traditionally negative for assets like silver, which do not yield interest and become less attractive when real returns from risk-free assets rise. The market reaction was swift and brutal. Almost instantly, what had been a bullish environment flipped into a bearish one. Silver's price, which had been trading well above $120 an ounce, began to fall with alarming speed. Initial selling pressure came from traders taking profits after the parabolic rally, but it did not stop there. The shift in sentiment sparked a chain reaction. Stop-loss orders were triggered, algorithmic trading systems began to sell, and leveraged traders faced margin calls that forced them to liquidate positions. Exchanges like the CME Group raised margin requirements on silver futures in response to the volatility, meaning that those holding large, leveraged positions suddenly had to post more collateral or see their positions automatically closed out. This margin squeeze exacerbated the decline, as forced selling added to the downward momentum and created a feedback loop of liquidation that fed on itself. By mid-session, the price collapse had gathered such momentum that it was clear this was no ordinary market correction. Spot silver prices plunged as much as 37% from their highs, with futures contracts on the COMEX tumbling more than 30%. Marking the worst single-day percentage drop since the early 1980s. Exchange-traded products tied to silver also saw extreme losses, with leveraged ETFs suffering record declines as the cascading sell-off hit even those vehicles designed to amplify performance. Across global commodity venues from New York to Mumbai, silver markets were red across the board, and many trading platforms briefly imposed circuit breakers to curb extreme volatility. Market participants described the environment as a liquidity vacuum. At critical price levels, buyers simply disappeared, leaving only sellers. In markets where liquidity dried up, even modest orders had outsized impacts on price. Traders watching the tape saw prices gap lower, with bids sometimes vanishing entirely until much lower levels were reached. Such behavior is typical during flash crashes or panic episodes, but for a major global commodity like silver to experience such extreme moves underscored the severity of the repricing that was underway. The broader context amplified the effects. Silver's meteoric rise had been supported in part by leveraged speculative positions and technical momentum indicators that signaled a blow-off top. When sentiment shifted, those same factors worked in reverse, creating a dramatic unwinding. Hedge funds and large speculators had already begun reducing net long positions in the week before the crash, and when the catalyst hit, there was little resistance to the descent. What had appeared as a runaway bull market suddenly revealed its fragility when faced with a change in macroeconomic expectations. While the immediate trigger was the Fed news and the resulting strength in the dollar, the context included overextended technical conditions, high leverage, and a market environment ripe for a sharp reversal. In the physical market, inventories remained tight relative to open interest, highlighting a disconnect between the paper price collapse and underlying supply dynamics. Nevertheless, on January 30th, price action was dominated by paper markets and the cascade of forced selling that followed the shock to sentiment. By the end of the session, silver had lost more than a third of its value from the recent peaks, and gold, often considered a more stable precious metal, had also suffered steep declines. Market commentators called it the most violent retracement in decades, if not half a century. Investors who had bought near the highs saw significant losses, while risk managers and analysts scrambled to reassess their positions and models in the wake of such abrupt repricing. In the aftermath, questions swirled about whether this represented the end of silver's long, intense rally or merely a painful correction within a broader long-term trend. Many analysts stressed that fundamental drivers like industrial demand and supply deficits remained intact, but others warned that volatility might persist as markets digested the implications of new monetary policy expectations and unwound overextended speculative positions. Regardless of the long-term outlook, January 30th, 2026 will be remembered as a historic turning point, a day when sentiment shifted, liquidity evaporated, and the silver market's parabolic ascent met the harsh reality of risk reevaluation and forced liquidation. If you found this video helpful, don't forget to like, share your thoughts in the comments, and subscribe for more deep market insights every day.